Tom Lee just said, the most hated rally is about to shock everyone. That's the line everyone's talking about, and today we're breaking down exactly what he meant, why it matters, and how you can position yourself for what comes next. I'll show you the clip in a moment, then I'll walk you through my reaction and a deep dive analysis of the 2 best growth stocks to buy right now, based on what he said. If you only watch one video today, make this it watch all the way to the end. Hit the like button, help us get to 1,000 likes, share the video, and drop your thoughts in the comments. Subscribe so you don't miss the next market update. Alright, let's hear what Tom Lee has to say.
I'm going to take issue like I did last time with a comment that you gave to our producers, Tom. You think it's still the, quote, most hated rally. I just don't know how that still holds water, given where we are. I mean, I interview people all day, every day. I've got no bears around.
Well, I mean, maybe some of the bears have gone to hiding, Scott, but because the last time we talked, I wanted to give you some quantitative stats. If you take AAII, which I think is one of the best surveys of high net worth retail investors, it's averaged minus 11.7 this year, negative 11.7. There have only been 3 other times in that survey's 35-year history where the year-to-date average has been negative. It was 1990, 2002, and 2022. So all those times have actually been associated with bear markets. And so sentiment has averaged this year what's consistent with a bear market. So it is the most hated V-shaped rally. Now, there may be some people who say they're no longer bearish, but their P&L doesn't reflect that.
No, that may be fair. Which leads us to the potential of a chase into year end when they realize that what's at stake for them if they're not engaged.
That's right. And we know 80% of fund managers are trailing their respective benchmark this year. It's the worst in almost 25 years. So, and now they're given 2 things to work with. One is that seasonally, November's a good month, so it should be a positive month. And as far as earnings go, and you guys had a conversation about it earlier today, margins have been improving despite tariffs. And so it's showing you that companies, I think, using AI are able to expand profit margins. That's actually a pretty good tailwind because the tariff headwinds are fading, but the benefits from AI margin benefits are still going to grow.
Now, I'm a little surprised, maybe not much, but just because you have a history of liking small caps over the last year or so, but particularly coming off the Fed meeting, where the Fed chair went out of his way to say that December is not a foregone conclusion, and then underscored that with far from it, which obviously, if rates aren't going to go down in the trajectory that you probably thought they would, then small caps are probably not going to perform the way you thought they might.
Yeah. One thing to keep in mind is that, if you look at Fed Fund futures, it's still projecting a cut in December. I think Fed Chair Powell in his statements did give you a window for why it's possible. One is he did acknowledge that inflation's effect from tariffs is less than they expected. And despite a lot of Fed governors talking about inflation widening, that's not the case. When you look at the CPI report in September, it was the highest percentage of components, 54%, that were in outright deflation. So in fact, inflation is falling like a rock. And the second was he acknowledged that rates aren't accommodative. They're just less restrictive. And so in a case where there's falling inflation and if jobs market's weakening, I think that that's a good reason for cuts to happen and in a way that's good for equities.
Yeah, but I mean, we were talking about December probabilities, Tom, before the meeting at like 100%. Now they're down. And some, like, Jeffrey Gundlach, who I interviewed the other day post-Powell, was like, could be 50-50. So maybe that particular trade gets paralyzed, if you will, between now and the next meeting because we just need to see what the Fed's going to do before we become big believers in the small caps.
Yeah. Well, I'm going to do something that the Fed will not want to do, which is be a little forward-looking. But we have a government shutdown that's continuing that is causing even things like air traffic to slow. And inflation isn't going to be gaining strength in a period like that. So if the Fed was acknowledging inflation's weakening now, I think it's even weaker in December. at a time when the labor market is suffering. So I think if someone thinks the odds have dropped because of what the Fed said, I just think the data would support a very opposite picture.
So, let's start at the top. Tom opens with the sentiment piece. He points to a survey of high net worth retail investors, the AI survey he mentions, where this year the average reading is negative 11.7%. Only 3 other times in the 35-year history of that survey have we seen year-to-date averages in the negative: 1990, 2002, and 2022. He interprets that as being consistent with bear market sentiment, even though the market has been rallying. And from that, he concludes, we're in what he calls the most hated V-shaped rally. What does that phrase mean? We'll break it down. On one side you've got the V-shaped rally part. The market had a sharp drop, or at least big uncertainty, and then recovered relatively quickly. On the other side, most hated means that the rally has very little love. Investors are skeptical, sentiment is low, many remain bearish despite price action moving higher. Tom is saying, yes, the rally is real, but it's happening in spite of very weak sentiment, not because we're all suddenly bullish. And that's a huge part of his thesis. He argues that when sentiment is depressed and you have meaningful tailwinds, we'll get to them, this kind of environment can be a potent setup. In his view, the fact that everyone is hiding, or some bears are in hiding, means there's latent capacity for those who have been sitting on the sidelines to rush in, especially toward year end, because 80% of fund managers are trailing their benchmarks this year, another stat he throws out, and there's a seasonal tailwind. Historically, November tends to be a good month, so let's unpack the pieces of the conversation step by step. First, sentiment and why it matters. Tom's statistic that the survey average is 11.7% is powerful because it gives you a quantitative anchor. Investors are not bullish, they're negative. Historically, look at years like this were bear markets, and yet we're not obviously in a conventional bear market. We've got a rebound, we've got earnings showing strength. He uses this to argue that the current rally is unusual. That's why he calls it most hated. If people were bullish and prices were rising, that would be more typical of a late cycle or euphoric top. But here we've got prices up while sentiment is down. That tells you the underlying psychology of the market is different. From my vantage, this is one of the most important takeaways from the interview. Too often we talk about valuations, earnings, macro, but sometimes the psychology underlying the market is overlooked. Tom is saying don't ignore how unhappy investors are because when they shift, you could get a surprise move. So I agree that this sentiment piece is under-discussed and meaningful, but I also flag, low sentiment is not always a guarantee of upward move. It gives you potential and it must pair with tailwinds. Which brings us to the second major theme, tailwinds. Tom highlights a few. First, margins are improving despite tariff headwinds. He argues that companies using AI are boosting profit margins, which is something not often credited in the mainstream narrative. Tariffs get more attention. The combination, headwinds fading, plus new tailwinds emerging. A favorable backdrop. He also points to the fact that the Federal Reserve is acknowledging inflation's impact from tariffs is less than expected, plus that a large component, 54%, of CPI items in September were actually in outright deflation. He uses that to argue inflation is falling like a rock. This sets up the possibility of rate cuts down the road, which is positive for equities. In our reaction mode, this is a strong part of his argument. If margins are indeed improving and cost pressures easing, that's real fundamental backing. Too often bullish sentiment is dismissed as pure liquidity or faith in policy, but Tom is saying no, there's structural earnings support. That gives the rally more credibility. I'm inclined to believe that part has teeth, though I'm cautious about assuming margin improvement continues unabated. There's always risk of inflation spikes, geopolitics, supply chain shocks. Next, Tom and the interviewer have a conversation about whether small caps can perform given the Fed's remarks. The interviewer points out that after the Fed meeting, where Chair Jerome Powell said December is not a foregone conclusion for a rate cut, the probabilities of a December cut came down. That usually hurts small caps because they more directly benefit from an explicit cut and a lower rate regime. Tom's response, the futures market is still projecting a December cut. Powell's comments actually acknowledge two positive things. Inflation impact from tariffs is less than expected, and rates are less restrictive, not yet accommodative but closer. Additionally, Tom brings in a forward-looking view. We have a government shutdown dragging air traffic, labor market weakening, meaning inflation is likely to be even weaker into December, increasing the odds of cuts. In our commentary, this is clever. Tom is painting a scenario where policy could become more favorable even if headlines say, Fed cautious. He's further mixing in macroeconomics, government shutdown, labor conditions, to argue for lower inflation, which is supportive for easing. That said, as the interviewer flagged, there's a risk. If the Fed doesn't cut, or if inflation rebounds unexpectedly, that could disappoint momentum in small caps. So I'd say his bullish tilt is defensible but not risk-free. I'd remind viewers, betting on cut in December is a conditional trade, not a sure bet. Another theme, fund managers trailing benchmarks. Tom notes that 80% of fund managers are behind their benchmark. That means there's pressure. If you're a fund manager underperforming, you may have to chase performance. He uses this to argue for potential chase into year-end behavior. Managers who've underperformed may pile in, which itself becomes a tailwind. This links to his sentiment piece. Low sentiment, plus underperforming managers, tron potential for catch-up flows. From my vantage, flow dynamics like this are often overlooked, but they can matter. The logic is, performance pressure can cause herding behavior. So this is another layer in his argument. I buy the narrative that there is a pressure cooker environment pushing money into equities. But again, caveats. Flows won't override fundamentals if fundamentals deteriorate, but as a potential booster for the rally, it's a valid angle. Then the conversation comes back to, what does this mean for 2026 and beyond? Tom is very clear that we're not at a euphoric stage yet. He sees the structural backdrop still favorable. AI productivity gains, margin improvement, potentially loosening monetary conditions, etc. He seems to believe we're in the early middle innings of a new cycle, not the end. That's a very important contrast to more cautious views. Many are saying, we're late cycle, time to be defensive. Tom pushes a more constructive view in ours. This is where I both like and caution. If you adopt Tom's view, you'd lean into equities, tech AI, maybe small caps, where the policy and margin tailwinds are stronger. But you'll also need to maintain a risk-aware frame. If inflation re-accelerates, if geopolitics blows out, if earnings disappoint, the rally could reverse. So the viewers should understand that while Tom is bullish, he's not recklessly ignoring risks, but neither is he playing safe. He's saying, this could be bigger than people think. One bit I want to highlight, Tom's mention of the unusual nature of this rally being hated by many because of politics, algorithms, data distortions. He suggests that sentiment measures, even algorithmic systems, are contaminated by political bias, and that's a subtle but potent point, the idea that the market is not acting in the usual way because the input, data plus sentiment, is skewed. If true, that further supports his thesis that the market move is underappreciated. As a narrator to your audience, ask yourselves, could there be hidden positives the market isn't pricing simply because the crowd is distracted or biased? Finally, let's talk about what this means for you, me, and the viewer in practical terms. If I were summarizing advice based on Tom Lee's views, consider that equities, especially segments tied to AI margins, may still have runway. Keep an eye on policy indicators, Fed commentary, inflation data, labor market, because they still matter. Be attuned to sentiment shifts when the most hated rally starts to get loved, that could amplify the move. Recognize that, while small caps might be more sensitive to policy, they could benefit dramatically if the cut comes or if data weakens. But don't ignore risks. Inflation surprises, Fed hawkish pivot, external shock are still real possibilities. Prepare for asymmetric opportunity, low investor belief, saplo real fundamental tailwinds, possibility of outsized upside, but staying nimble is key. In closing, Tom Lee's interview gives a compelling framework for how we might be in a market regime that differs from the past. A rally built not on euphoria, but on improving fundamentals plus depressed sentiment. If he's right, there's significant upside yet to be unlocked if you're positioned early. But if he's wrong, the weak sentiment could just give way to more frustration. As we as investors or viewers watch the next few months unfold, I'll be looking for signals. Whether fund managers begin to chase, whether the Fed really pivots, whether AI margin improvements show up in earnings. That will tell us whether the most hated rally can become the broadly accepted one and maybe a sustainable one. Thanks for sticking with me through this breakdown. If you found this helpful, hit like, subscribe if you haven't already, and ring the bell so we don't miss any upcoming breakdowns like this. Drop your thoughts in the comments. Do you believe we're in this kind of most hated V-shaped rally? Or do you think sentiment remains justified and there's more downside risk? Now let's dive into the 2 best growth stocks to buy right now based on what Tom Lee said. For our first company on the list, imagine ordering groceries, headphones, even a birthday gift, at 11 p.m. Then it all shows up before you wake. In one of the world's most advanced connected economies, that speed is now the standard. This didn't happen with a simple website. It took an ecosystem of logistics, technology, and customer obsession. Owning the journey from shelf to doorstep became the secret sauce. Relying on third parties was slow, costly, and inconsistent. So this company made a bold, expensive bet. Build its own delivery network. warehouses, an army of drivers, and sophisticated software at national scale. It burned cash in the short term but forged a moat that rivals can't easily copy. Control the process, and you control the speed, the cost, and the quality. The company we've been describing is Coupang, ticker CPNG, South Korea's e-commerce leader. Comparisons abound, but Coupang's nationwide speed sets a new bar. Order by midnight, wake to delivery. It's a core promise across millions of products. Strategically placed centers keep inventory close to most households. Precision and proximity/transit time. Yes, it was capital intensive, losses early, with a long-term moat in sight. By owning logistics, Coupang controls its destiny. Beyond retail, it layers services, fresh food, entertainment, local delivery, and member perks to deepen loyalty. A classic flywheel, each add-on makes the platform stickier. In a wealthy connected market, Coupang is embedded in everyday life. Coupang's next leg of growth: deepen relationships with existing customers. The heavy lifting, its nationwide network, is largely in place. As orders scale through fixed assets, cost per delivery falls. That operating leverage is driving a turn toward profitability. Higher margin layers, advertising and third-party marketplace, boost blended margins, asset-light revenue streams on top of a logistics base, powerful math. Groceries are huge and hard, but Coupang's network gives a head start. Win fresh, and you capture more household spend. Eats and entertainment strengthen the super app loop. International tests are early, risky, but the blueprint travels to dense urban markets. Coupang's strength, its physical network, is also its biggest risk. World-class logistics are extraordinarily expensive to build and maintain. The spending doesn't stop, service levels must stay elite. If growth in consumer spending slows, fixed costs bite harder. Competition is relentless. Local and global players push on price and speed. Price wars or costly innovations can squeeze margins. Growing dominance invites regulators. Labor standards and practices face scrutiny. Stricter rules could raise costs and slow operations. And diversification, doing too much, can distract from the core. Execution is a balance. That's the crux. Coupang comes with a market capitalization of roughly $58.28 billion. Last year it pulled in about $30.26 billion of revenue, and on the bottom line it reported net income of $154 million, so it's profitable but not printing massive profits relative to its top line. Earnings per share sit at about 20 cents, and the price-to-earnings ratio is very high at roughly 159.85. That combination tells you a couple of things at once. Investors are paying a premium for growth and potential margin expansion, yet today, the stock trades at a valuation that requires continued execution. The revenue scale is impressive, billions in top-line sales, and the fact that Coupang is profitable separates it from many high-growth peers that are still loss-making. But with earnings per share so modest relative to its price, the market is pricing an outsized improvement in margins, operational leverage, or new revenue streams. If those improvements materialize, the PE could look justified. If they don't, the valuation leaves little margin for error. For our second growth stock, every year, people leave home to work and to support family across borders. Construction crews, nurses, engineers, caregivers, the backbone of economies. Remittances are lifelines: food, education, healthcare, housing. Old systems were slow, inconvenient, and expensive. The smartphone changed everything. Connect and send from the same device. New platforms made transfers faster, more transparent, and cheaper. Money can arrive to bank accounts or wallets. Driven by necessity, this market is large and resilient. Serve it well, and you can build an enduring business. Remitly Global, ticker RELY, is leading this digital transformation, built to be faster, more affordable, and more transparent. User-friendly and mobile-first, designed for immigrant communities. No storefronts, just sophisticated digital rails and global banking partners. Revenue comes from transaction fees and foreign exchange spread. The key is volume. Small fees add up at scale. Delivery promises and clear ETAs build trust. If a transfer is late, a money-back guarantee backs it up. Remitly systematically expands corridors, sending and receiving routes worldwide. Scale improves partner terms, strengthening margins and the moat. Secular tailwinds propel the story. Remittances move from cash and informal channels to digital. As smartphones spread and comfort with digital finance rises, so does the customer pool. Each year, new workers start with digital natives' expectations. Growth lever, methodically open and scale new corridors. Network effects kick in as users refer across destinations. With trust established, there's room to add adjacent financial services. Think savings, credit and protection products tailored to customers' needs. That can transform a single product app into a broader platform with higher revenue per user. Because sending money home is non-discretionary, the category carries a defensive quality. Competition is intense. Digital rivals and modernized incumbents pressure pricing. A race to the bottom on fees can impair profitability. Regulatory complexity is constant. AML and KYC rules everywhere. Failures can trigger fines, license issues, and reputational harm. Policy changes can suddenly alter or shut down corridors. Dependence on partners adds risk. Losing one can disrupt service. Partners may demand more economics as volumes rise. Its market cap is roughly $3.3 billion, and it generated about $1.26 billion in revenue last year. But Remitly's bottom line is still in the red. It posted a net loss of about $36.97 million, and earnings per share are roughly 6 cents, while the reported price-to-earnings ratio is an eye-popping 267.33. In practice, that PE signals that either investors expect rapid earnings acceleration or they're valuing future growth very highly despite current losses. For Remitly, the key questions are execution and path to consistent profitability. It's a much smaller company than Coupang, with less margin cushion and more dependence on scaling its business and improving unit economics to convert revenue growth into durable profits. Two compelling leaders, different models, different risks. Coupang is a bet on physical dominance, an empire of steel and concrete delivering overwhelming service. Success hinges on sweating assets and scaling profitability. Remitly is a bet on an asset-light global network, an empire of code and partnerships scaling across borders. Win by acquiring customers efficiently and sustaining trust at scale. Your choice reflects your philosophy. Physical moats or digital networks? Looking 10 years out, which model endures? Coupang's integrated logistics or Remitly's asset-light network? Tell us why in the comments. Both are powerful growth stories built on human needs. The path will be volatile, but patience can be rewarding. Putting these two side by side gives you a clear risk-reward contrast. Coupang is large, growing, and already profitable, yet priced for perfection on margin improvement. Remitly is smaller, growing its revenue base, but still loss-making, and therefore carries higher execution risk with a valuation that presumes a bright future. For investors, the decision hinges on conviction. Do you believe Coupang can widen margins enough to validate that high PE? Or do you prefer Remitly's higher growth optionality and accept the operational risk and the need for future profitability? Both stories have upside if execution and market conditions cooperate, but both also demand discipline because the market is already assigning lofty expectations to each company's future earnings. That's all I have for you today. Don't forget to like, share your thoughts in the comments, and subscribe to the YouTube channel so you don't miss out on the next important financial investing update. Thanks for watching, and I'll see you in the next one.